And then we look at the how. How will these things work after the changes? How will things work? How will we now operate with these new changes as they came into effect on the 3rd of August? We see the return of the dual rate VAT return. Some of you would have noticed that after the VAT rate increase that took place in April 2021, BRS deployed a VAT return that had two rates. One section that speaks to the 12th percentile supplies, and one that speaks to the 14th percentile supplies. That was to cater for the transitional period, to make sure that invoices that are reflecting VAT at 12% have where they go, and the ones which have 14% have where they go. So most of you who would have prepared a VAT return then would pretty much recall and understand what we are talking about. But if you haven't seen it, you can talk to AccPro, and if you're interested in seeing it, we would be very much willing to take you through what it is, how it works, and how we can help you in actually processing such. And I think in terms of what has happened with the current transition from the 14% to the 12%, I think we should give BRS its props, because they were quite, they hit the ground running in terms of taking that into the VAT return and actually putting through this dual rate return, because in the previous amendment that saw the increase of the VAT rate, there was quite a bit of a delay from BRS's side, because I know everybody was scrambling almost at the deadline when that amendment came through, because BRS had issued the return quite late to actually cater for those. I remember I had quite a number of calls with the e-filing team that deals with the programming of these returns online, to actually say, but guys, how are you expecting people to file returns which have 14%, 12% invoices, while the rate has been changed to 14%. So I think we need to give them their props in terms of the transition into this new amendment. We look at cooking oil and fuel station, cooking oil suppliers and fuel stations. So I was talking about this zero rating aspect earlier on. So basically what happens when or what the minister means by zero rating the supplies of cooking oil and fuel is the fact that VAT on these commodities is deemed to be at 0%. What sets out the difference there is we have another wing or another basket of supplies which is deemed to be exempt supplies. So exempt supplies are those supplies which we do not mention the concept of VAT anywhere near those. So those are commodities which tax is not to be mentioned anywhere near those. And then you have your cooking oil and your petroleum gas. So these are commodities which VAT is charged, but it's charged at 0%. So what this concept is trying to do is the fact that for your exempt supplies, if you have exempt supplies, like your financial services, you are not allowed to claim the input VAT on whatever expenses that are aggregated towards those exempt supplies. But the law actually allows you, in terms of zero-rated supplies, to claim whatever input VAT you incur in actually generating your zero-rated supplies. So your input would be whatever expenses that are chargeable to VAT that you would have incurred in actually running your operations for the supply of cooking oil or the supply of petroleum gas. And one other thing that was worth noting is the fact that the rate change took effect on the 3rd of August, rather than what was initially stated on the minister's speech, because they had anticipated to effect it on the 1st of August, but rather the effect of it took off on the 3rd of August. I know a lot of businesses had a bit of a headache and issues with that change, because people kept asking, "Where's the Gazette? Where's the Gazette?" Those who are quite up to speed with what's supposed to happen in terms of legislation on these changes. So a lot of people, some of the companies had gone on to actually change the rate based on what the minister had pronounced in Parliament, and just from the 1st of April started issuing invoices at 12%. But then we saw the minister come on the Gazette that was issued, I think, on the 2nd, to say that the rate change will take effect. The commencement date would be the 3rd of August rather than the 1st of August. So what that means is any invoice that was charged VAT up to the 2nd of August should have been reflecting VAT at 14%, not 12%, 14%, because the commencement date is the 3rd of August rather than the 1st of August. And if you go to BRS and argue and say, "No, I have the minister's speech right here in my hand, it's in black and white," they will ask you, "Where is the Gazette?" And by them saying that, you have lost your case, because even the VAT Act states that the minister needs to gazette this rate change for it to actually come into force. So if you're holding on to the speech that came through from Parliament, unfortunately, my friend, you won't win the fight with that one. Into the transitional rules, which is the aspect that usually causes a lot of commotion, a lot of confusion. It's usually a long document. I think the current document is about 13 pages. BRS trying to make sure that taxpayers understand what they're talking about when they're saying there's Section 8, there's Section 69 and 70, which kind of deviates from Section 8, and then obviously somebody who isn't really practicing tax on a daily basis would wonder, hey, what is all this thing that the domestic tax arm is talking about? What is Ausiseha talking about? What is Mr. Bakwena talking about in terms of these transitional rules? So I'm just going to try and start off with simplifying a few basic principles of what needs to be what you need to be cautious about when we're talking about transitional rules, and what it is that it is trying to achieve, and why it is kind of deviating from what is the norm in terms of how we conduct business on a normal. So I think it's worth noting and trying to understand, first of all, what tax periods are in terms of the VAT Act. So this is set out in Section 25 for those who'd be interested in actually going into the law, the legislation, and finding where the Act speaks about this. So Section 25 is the one that prescribes the tax periods, and subsection 2 is what confers power on the minister to actually prescribe VAT categories. I think some of you would have, if you are VAT registered, you would have gotten a letter from BRS to confirm that you've successfully been registered for VAT, and then they will state that your company falls within category A or category B or category C. This is found within the regulations, which the VAT Act grants power to the minister to actually prescribe. So you have your category A, the regulations, how it says it, because some people always ask me, why is it that category A is not January, February, and then category B is February, March? It would make a lot more, it would make it a lot easier for me to remember my category if it was that way. So when you look at the regulation looks at the last day of that period. So category A, as per the regulations, is the one that has its last day of the month, of the first period, as the last day of January. So if you are running a bi-monthly period, which is a 2-month period, if your last day of a period should be the last day of January, then obviously we need to take in December of the previous year as the first month of your tax period. So that is what has actually led to, rather than you having a January, February as category A, because the regulations were looking to make sure that category A is the one that speaks to January, and then category B looks at the last day as being the last day of February. That's just to put it in perspective. And then you have category C taxpayers. These would be your taxpayers who have an annual turnover of more than 12 million, an annual turnover or above 12 million. The other aspects I won't cover, but the special circumstances where the minister may prescribe for an entity to be listed under category C, but I don't think they are worth us discussing today. I think I've covered that extensively in terms of what a tax period is, so, and how the different categories operate. And then we look also into the limitation of time in terms of import tax as prescribed by section 19(1)(a). So section 19(1)(a), what it tries to get to is if you are a business, obviously you have your sales, right? Whatever goods, whatever services you are offering your customers, those would be your output tax that relates to the sales. And then there is the aspect of what you are buying, whatever raw materials you need to actually manufacture the goods that you are gonna sell, or whether it means you actually ordering finished goods and actually reselling them. There's an expense that you actually incur in terms of securing those from the suppliers into your business. So input tax here, we're looking at that aspect of whatever you're trying to put into your business in order for you to be able to make your sales. So whatever you're incurring, whether it's your telephone costs, whether it is your stock, or inventory that you're purchasing from your suppliers, that is the aspect that we're looking at in terms of input taxes, input tax in VAT. So the concept that is being brought about by this section is primarily to say, if you have invoices, for example, your category A guys, they are returned for the period July 2022. As we all know, or some of us may know, your VAT return is due on the 25th of the month following the end of your tax period. So the June-July returns for category A taxpayers would have been due by the 25th of August. So what section 19(1)(a) says is that when you have input tax that relates to the June-July return, and you were not able to actually claim it under the June-July return. It could be due to the fact that your suppliers weren't able to furnish you with an invoice well in time for you to be able to put it into that return. That is the usual and common reason that usually causes that. Then the law actually allows you to be able to put that invoice into the subsequent tax period, or the tax period that follows on after the June-July. So guys who are category A taxpayers will have their input tax for June-July being eligible for a claim in the August-September VAT period. So that is one aspect which is being covered by the transitional rules that have been issued to say that if you are category A taxpayer, your input claims for June-July return will be exhausted by within the August-September return. If you still have a claim that relates to the June-July return that isn't claimed under the August-September tax period as a category A taxpayer, know that you will not be allowed to claim it anytime after that period. You will not have any right per the law to actually claim that input. If you so do, and BEARS happens to pick that up, know that you'll be faced with whatever penalties BEARS has the right to impose per the law. And when we look at category B, obviously, their bi-monthly period overlaps with that of A. So your July-August return, which should be due on the 25th of September, those that will have some invoices that relate to the month of July, which is when we could say the most part of the 14 percentile invoices were issued, including those extra 2 days in August. That is when we expect your claim for the input to be exhausted by September, October. So if you have invoices that relate to July, August as a category B taxpayer, make sure that in your upcoming September, October return, all of those are claimed in there. Make sure to follow through with all your suppliers to provide you with the relevant invoices for you to be able to claim the necessary input tax on those. Then we look into the category C taxpayers. These are the guys who would be submitting their returns on a monthly basis. Like I said, these guys are the ones who have a turnover in excess of 12 million per annum. So the minister has prescribed that such taxpayers would be submitting their returns on a monthly basis. So the major focus here would be on the invoices issued in July, because those are the ones which you'd have VAT being charged at 14%, and obviously, like I was saying, those extra 2 days in August. So we have the VAT Act in terms of the type, the category C taxpayers, prescribing that they are eligible to claim input tax on 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 um on this invoices for the next successive 3 periods. So if you have an invoice that was issued in July, you should be able to claim it within the August return and within the July return, first of all, which is where it's supposed to go, and then the following month, which is August, and it is exhausted in September. Anything after September for category C taxpayers, which relates to 14% invoices, should not be there, because the law allows you up to September to actually put through those invoices. I trust that aspect has been covered in full. So I'm hoping that we keep all these principles and aspects in mind as we go forward, because when we get to the actual transitional rules, the provisions of the law that speaks to the transitional rules, they speak hand in hand to these basic principles for us to be able to understand them. That is why I'm spending quite some time to actually try and explain how does it affect the category A taxpayer? How does it affect a B, a C category taxpayer? And I'm hoping you're also listening at this and thinking of your whatever business line that you are running, and whatever category you might be falling in if you are VAT registered, to actually try and picture how you're going to do things going forward, or how your tax representative, your tax agent, your tax advisor should be doing things going forward. And then we look at the time of supply. The time of supply is where the focus of the transitional rules is. Yes, there's a bit of it that touches on the two aspects that I've been talking about, which is the categories there and the the limitation of claiming input tax. So the time of supply or the tax point. What do I mean when I say time of supply? What do I mean when I say tax point? Some tax experts rather call it tax point. So this is a date, or a date which by law a VAT supply is deemed to have happened. So when we say a time of supply, we're looking at a particular occurrence that happens at a certain date that qualifies that date as the date when a VAT supply or a VAT transaction, if you don't want to say supply, has actually taken place. So when we look at subsection 1 of section 8, it states that the time of supply shall be the earlier of the invoice date or payment. So if an invoice is issued to you on the 31st of July, and then you make payment on the 16th of August, Section 8, subsection 1 of the VAT Act says the earlier of invoice date or payment date. So in this case, because we made payment on, we were issued an invoice on the 31st of July, that means the time of supply to the company will be the invoice date. That is the principle here. And I know generally and in most cases, the way operations and businesses are usually run and are accustomed to is we only think of VAT when you have an invoice. But we are looking at the law, the principles of the law here, and that is what the law demands and expects. So if you receive a payment on the 31st of July and you are furnished with an invoice on the 16th of August, the tax point is still the 31st of July, because payment also, if it comes before invoice date, sets the tax point as the payment date. So this is the principle of the tax, the first aspect that we picked up in the transitional rules, which I think we need to keep in mind and understand it quite clearly in order for us to be able to interpret what Section 69 and what Section 70 of the transitional rules is talking about. So when we look at subsection 11, I did mention at the beginning that if you hear me talking too much about section this and that, you can just push that out of your head and just try and grasp the principle of what the law is trying to talk about. This is just for reference sake for those who would need to go back to the VAT Act and try and see whether Sly was not lying to the poor people who were listening to him. So if you want to go back and reference and make sure that whatever you're doing, you have a reference point, this is basically what I was trying to help you with. And then we look at subsection 11. Subsection 11 deals with goods supplied under a rental agreement or a periodic payment agreement. So these will be treated as successively supplied for successive parts of an agreement. So as an example, what this section is talking about is for example, if your company is renting out a warehouse or office space, in terms of periodic payments, you could give an example of maybe BPC is making a connection for you when they put in through that cable. Sometimes what they do is they expect you to make the payments for that cable if you get a payment plan with them over a couple of months. So it's on an installment basis. So you have an agreement to actually pay it over a certain period. So that is what we are talking about by saying it is a successive supply. Rent will be due on usually either on the 1st of every month or on the last day of every month. So every month it becomes due. Every month you are being supplied that service. So successively it is being granted to you. Every month you are getting electricity due to that cable which you haven't fully paid to BPC. So it's successively being the services successively being given to you over a period of time. So what we're trying to pin down is if a service is not being given once off, it's not like when somebody comes in with a truck loaded with goods and drops them at your office and then you pay them, you are done. But in this case now, it is something that recurs from month to month. How do we pin down where the time of supply is? So in this instance, or what this particular subsection tries to tackle is to say the supply in those kind of arrangements will occur, the time of supply would be deemed to be when payment becomes due or when payment is actually received. Obviously, your agreement would state when we talk about when payment becomes due, they will state that rent is payable either on the 1st of each and every month. There should be on your lease agreement that statement that actually is put as a clause to say when is payment due. And then in terms of when payment is received, it is at the discretion of the tenant, or in the case of BPC, whoever the customer is, to actually pay over to BPC or the landlord. So you can pay either early, or if you are one of those difficult clients, you pay late. So it's trying to tackle that aspect for recurring services, installment structured agreements, to actually pin down when the time of supply will be. And then we look at section 12, which then looks into much of the construction industry. Agreements that relate to construction, major reconstruction, manufacture, or extension of buildings or engineering work. So what these guys do is they will come and set the foundation, right? And then there comes in somebody else who will be doing the steelworks. And then somebody would be doing the walls. Then comes in somebody who's an expert in roofing. Then somebody comes in who will be doing the electrical, somebody who does the plumbing, until you have a fully fledged building, basically. So this actually tries to speak to that. And usually what happens in those instances, the guys in the construction industry will tell you, hey, I have to pay my subcontractor. I have to pay my laborers, eh? So it's trying to deal with those arrangements, because these aspects of the building are being delivered at different periods, and obviously it doesn't make any financial sense. For example, we have these crossovers that are being built in Gaborone. Excuse me for using Gaborone because I'm located in Gaborone. I know we have people situated in different parts of the country in this call, but we have projects which are running for 2-3 years. It wouldn't make sense for the contractors to be paid to put in work, invest their money in a project to only be paid 2-3 years later. So what the construction industry has is it has certified engineers who would certify the completion of certain components of the construction process, and clear it. And I understand even accounting wise, there's an IFRS standard that actually speaks to that, on construction contracts. So my accounting counterparts will actually understand this even the more. But even if you're not into accounting, I think you get the principle of what I am talking about. So what this subsection is trying to deal with is primarily that, to make sure and to tackle how do we address the issue of the timing of the supply in such an instance where now we're having different stages or components of a building being completed and payment being due for each component at a different time during the project. So what the law looks at in terms of such cases is the when the payment becomes due. When does it become due? Usually, most of the payments become due when the engineer, like I have said, comes in and certifies a component of the construction project as complete. If the foundation has been set, they come in, they assess it, they grant a certificate to say that this has been completed. And then that is when now the payment becomes due. Accounting wise, they will say that is when they realize the expense. We will look at when the payment is made. If which is very unlikely, the client decides to pay the contractor before they complete the job, then we deem the date when the payment was made to the contractor as the tax point. Or the other aspect that we look at is the invoice date. When was the invoice issued? That is the date when we will then deem as the the invoice date. So whichever one of these three components comes to light first is what we will deem as the tax point. So the earlier of payment, invoice issuance, or when payment becomes due after the engineer has certified the work is complete. So I'm hoping that aspect of section 11, section 8, subsection 11, and subsection 12 are quite clear, because we're gonna dive in deep on those, especially when we're talking about section 70, parts 1 and 2. And then there's another aspect worth noting. I think this one my attorney friends would be quite interested in, because they do these transfers of immovable property. So if you have property that is being disposed, the VAT Act has a special provision under Section 8, subsection 17, as to when it deems the time of supply to be. So it looks at the date when the transfer deed is registered with the registrar of deeds, or the payment date, whichever one comes early. So if you've spoken to your lawyer, told him, I'm looking to acquire a property in Gaborone North, for example, and they've done the paperwork, they've processed, you've agreed with whoever is selling you the property, your lawyer comes in, and you started the paperwork, it's taken a long time since the start of July, and finally your lawyer is able to actually go register the deed transfer with the Registrar of Deeds on the 31st of July. And then you get to make payment to your the one who's selling you the property only on the 10th of August, for argument's sake. Then we take the tax point as the date when the transfer deed was actually registered with the Registrar of Deeds, or the opposite thereof in a case where payment is made first. If payment is made on the 31st of July, and then the deed transfer is only registered with the Registrar of Deeds maybe on the 10th of August, then we will take the payment date because it came earlier than the registration date to be the tax point. I think that is worth noting. So in a case where, like in this case where now we've had the change of a rate come into force, if you bought a property and your lawyers had already went forward, or if you have went forward to actually go register that transfer with the Registrar of Deeds before the 3rd of August, then unfortunately that property, if it is being acquired from a VAT registered person, then that person is obliged to charge VAT at 14%. So he won't be wrong when he issues you an invoice or when he demands payment from you and says VAT is at 14%. If you get somebody in that situation, please advise them just to say, no, but that's what the law requires. That 14% is the precedent rate at the time of the registration of the transfer deed with the Registrar of Deeds. And then let's get into the transition rules themselves. We have two sections. which we are looking at in terms of transition rules. That is section 69, which deals with the variation of consideration. And then we have section 70 that deals with the application of the increase or reduction in rate. So section 69, what it means by variation of consideration. Particularly in this section, we're looking at subsection 2, because the minister in this instance has reduced the rate. Subsection 1 deals with when the minister increases the rate. So in this instance, we're focusing on subsection 2, because that is where the minister has actually reduced the rate. So what subsection 2 is saying is, if you are a supplier, and then so happens that the rate is reduced, the law expects you that from the effective date where the rate has been changed, the law expects you to actually reduce the VAT on whatever supply, whatever you're charging to your customer, to the precedent rate at the time. So it's actually the clause or the provision that gives the right to the supplier to actually reduce the rate. It is the one that gives guidance in terms of looking at the timing principles that I've been dealing with in section 8, right? We've been looking at the timing principles under section 8, where we were looking at the area of invoice and payment, or in terms of rental agreements and periodic payments, and those construction contracts, how we deal with where the time of supply is. It still looks at section 8 and says, guide me on when the time of supply is, right? But we're looking at when the rate was changed here, when the minister has changed the rate. So in a case where we look at a time of supply and say, no, these goods were actually invoiced on the 2nd of August. What section 69 says is, well, if your goods were invoiced on the 2nd of August, what does section 8 say? Section 8 says the earlier of invoice or payment. So your invoice has already triggered a VAT supply. So since the precedent rate at that time, I think I'm not doing quite good for time. Excuse me, Zoe and Craig. I'll try and push it a little quicker. So what section 8 is saying is, the invoice date is the time of supply. So the rate that is precedent is the 14%, because the 12% only comes into effect on the 3rd of August. So section 69 hangs on section 8, but then it's the one that actually gives the right to vary the rate to the supply. And then we look at section 69, subsection 3 and 4. This part of the Act deals with the effects of rate change on fees charged on other amounts prescribed under other acts of law. So we have other laws which charge different types of taxes. You have things like your alcohol levies, in the tourism industry, they have the bed levy. You have a couple of those those taxes, if I may call them, or levies. There are instances where the minister may amend other levies in order to achieve a certain outcome. If that outcome is being achieved by the alteration of another levy, then what this provision is saying, you should not benefit the same outcome from another act of law. If the tourism levy is reduced to cushion the inflation, and the VAT is reduced to cushion the inflation, what it's basically saying is you shouldn't benefit on both sides. One should be the one that you actually derive a benefit from. And then we look at section 70, the application of the increase or reduction in rate. So section 70, subsection 1 looks at goods delivered before the effective date of the rate change. So section 70, subsection 1 is the one that actually kind of deviates from section 8, subsection 1, because we know from subsection 1, time of supply is prescribed by invoice date or payment date, whichever one is earlier. So in section 70, what it says is when we're in the transition period where a tax rate has been changed and goods have been supplied before an invoice or payment is made, and these goods have been supplied before the rate actually changes, then we look at the time of the supply of those goods as the tax point. That is the principle there that this section is trying to address. So if you have goods that have been delivered to you, but an invoice hasn't been issued or payment hasn't been made before the 3rd of August, then there is a taxable supply there. We have a tax point, we have a time of supply. And then section 70, subsection 5 sets out the criteria to follow in order to meet section 70. And this is the principle that I've been talking about. What needs to happen for us to look at the delivery date as the time of supply rather than the invoice and payment date. We look at the delivery of goods, and in terms of your rental agreements, we look at the possession of or occupancy of goods or whichever building you'd be getting into. And then the last aspect deals with section 70, subsection 2 and 3. So basically these two are the inverse of each other. They both look at the components of section 8, subsection 11 and 12. Just to remind you, subsection 11 looks at rental agreements and payments made in installments. And then subsection 12 looks at your construction, reconstruction, those ones which we were talking about earlier on. So what section 70 subsection 2 speaks of is if an agreement is entered into and it begins and ends before the date where the rate has been changed. An agreement is entered into and and the supply begins and ends before the rate is changed. You enter into an agreement on the 1st of January. Let's say you are renting out a printer in your office from Nashua. Enter into an agreement, and then a couple of months down the line, on the 31st of June, you no longer want Nashua's machine. That contract was fashioned, or it was made in a time period before the current change of the VAT rate, which is the 1st of January 2022, and then you end it on the 31st of July 2022. So that happens within the time period where the VAT rate is at 14%. So when such agreement are not affected in any way whatsoever by the rate change. Everything that pertains to that agreement should be at 14%, even if the payments for those agreements are made after, or the invoices are issued after, because of this section. And then what subsection 3 speaks to is contracts which had been made before the VAT rate change. Let's take the same agreement with Nashua. We started on the 1st of January 2022, and it only ends on the 16th of August 2022 today. Then in that instance where you have a contract that overlaps between two different VAT rates, then what happens is Section 73 allows for a fair apportionment of that contract. For example, if you have a construction contract, for example, we would look at the phases that have been completed through the months and look to apportion the part of the costs which would relate to the 12% rate and the ones that would relate to the 14% rate. Obviously, we'd be looking at the certificates issued by the assessing engineer to say, so which part of the job was completed on or before the 3rd of August, and which part of the job was complete or was worked on and completed from on and going forward to the 16th of August. So we will look at that, and then we measure it in terms of percentages to say what percent relates to the period before 14%, what portion relates to the period that gave rise to the 12% VAT rate. And then subsection 4 just helps to distinguish which rate to be applied. So this is the one that actually gives meat to section 3 to say, in such an instance where this portion of the contract which relates to the 14% side, and then this is the section of the agreement that relates to the 12% part of the contract. I think I've done a fair bit of talking, and I will open the floor to questions.